Hi everyone, welcome to another Honeystocks.com stock market outlook video for the month of October. Now before I do the usual and switch over to my screen share and walk you through many of the charts and a lot of the data that I think most of you tune in for, I just want to take the opportunity to thank everybody. After last week's video, I put out an analysis covering a lot of the key market support levels. I will link it at the end of today's video, but I had a lot of email requests, a lot of Twitter DMs just asking me to do a follow-up on last week's video, so I have a lot of charts and new data to present this week as well. I've put out my weekly letter on Wednesday. You can probably check that out on the website, and of course lots of charts to follow up on that I have posted to Twitter this week as well. Now, as most of you know, I do not use the magical hindsight indicator. I timestamp all of my work. If you were to sit and have a beer with me, the first thing I would tell you is, although I use technical analysis, I am not a short-term day trader. I could not think of anything worse. If you are a minute time frame day trader, there's plenty of day trading gurus that will happily take your money elsewhere on YouTube. For me, my time horizon is generally weeks to months, and primarily I'm looking for a trending market or rebound levels in the market, and I think there are a lot of charts this week that I think you might find a lot of value from. Just to go over a couple of my recent calls, I called the market top right at the start of the year before all of the carnage started. I called the market bottom in June. I've called the September carnage right at the start of September, and like I said, I timestamp all my work and I like to keep things simple. Now, if you do get some value from this week's video, please do like and subscribe. Feel free to follow me on Twitter as well. And just finally, to give myself a little bit of credibility, I am registered with the CMT Association, working my way towards my CMT, and of course, please pause the video and make sure you're comfortable with that. Very important disclaimer. Basically just says that there's not any investment advice, and do all your own due diligence. So let's flip over to the screen share and let's walk through some charts. So I think it makes sense to start this week's analysis with a chart that I've picked up from social media this week from Oppenheimer. And what the chart is essentially showing is that when we have bear markets, oftentimes October tends to be the month where these bear markets effectively bottom. Now, I'm sure for those of you that are long only and are looking, buying stocks, September has been a pretty brutal month. I get it. Now, the big question that we have is what comes next? Well, if we look at the fear and greed index, we can see that it's not looking too great when we consider sentiment out there. But what I am more interested in is what is happening with the broader market. Now, this will be quite a detailed analysis where there is an emphasis and a huge focus on the most important charts for my work. And as always, I'm going to start off with the US dollar index. Now, if you picked up the analysis that I've been putting out over the last month, you'll know that I've been looking at these extreme readings with monthly RSI and anticipating some kind of pullback with the dollar. Now, that has ultimately played out as expected in the short term. The RSI level did get as high as 82. We have pulled back in the dollar a few percentage points, but nothing really to write home about at the moment. So this chart is still very, very much intact. The upper target level of 120 is very much still in play. Yes, we have had a pullback. I was hoping that we would get a bigger pullback in the dollar so that we could see stocks catch a bit of an extended bear market rally, but ultimately that hasn't really played out. Now, I posted this chart to Twitter this week as well. Now, what this chart is showing is the correlation between the volatility index and, of course, the US dollar index. And what the chart is essentially showing is, well, if we have correlations with these two areas of the market, we all know, and I would hope that everybody knows, that when we have a spike in volatility, that's generally an environment where stocks aren't doing too great. So the question I've had this week is, well, if we can anticipate a pullback in the US dollar, it's logical to expect some kind of pullback with the volatility index. And of course, if we get a pullback with the VIX, again, hopefully we could get some kind of extended bear market rally. But again, we have not seen that this week. Now, another chart that I posted to Twitter earlier in the week was this one for the Dow. Now, given the correlation between the Dow and the S&P 500, the charts are essentially identical. For me, the philosophy that I have when we are looking for, breakdowns in the major averages, or whether it be a failed breakout, there's always one index that gets the crash party started, as I like to call it. And for me, the Dow has shown me this week that it's broken below its 200-week simple moving average. It now has broken below the June lows. This isn't a bullish development for the market. And the question I really have is, well, if the Dow is breaking rank, how will that impact the S&P 500? Well, I think it's quite reasonable to expect the S&P 500 to follow suit. Now, going into October is quite strong seasonally most of the time, but I think the market is at a very big inflection point where if we start to get a breakdown in the major averages, I think it makes a lot of sense to start looking at other areas of the market to potentially start to hedge, etc., etc. We've got the triple Qs again. The charts are almost identical. We've got the 200-week simple moving average again. We're pushing up against those June levels. The mid caps, again, I would expect a pullback to the COVID crash declines. We've got the small caps hanging in there. So if you are in the market is going to rebound spectacularly camp in October, you probably want to see the Dow do an about turn Monday, Tuesday. I think if that doesn't happen, I think it's quite reasonable to expect the S&P, the small caps, the micro caps, again, to all start to follow suit. Now, if we have an environment where, again, we have all the major averages breaking down at the same time, I don't think that's particularly good for stocks. I've been prepping our clients and members for this exact scenario for the last couple of weeks, highlighting these levels. Yes, we can anticipate, bear market rallies here and there. I've done that right here. But ultimately, we're pulling back to these levels, and I think the market's at a big level. Again, you've got the financials. If the financials start to break down, again, what does that mean for the broader market? I don't think that is particularly bullish. So again, I think it makes a lot of sense to start looking at other areas of the market. Of course, I think everybody that's followed my work over the last few months will know that this is a chart that I've been floating about here and there. Again, it's one of those charts, though it is unlikely, but it is possible. I think that's something that I wholeheartedly accept with the market. I think anything is absolutely possible. And again, if we start to see words like capitulation, etc., these extreme bearish targets don't seem so ridiculous. I actually posted to Twitter earlier on today because I was seeing that there's a very prominent financial media analyst. I won't name him. He's calling for a year-end, 5,200, I think it was, bullish target. He thinks that there's about to be an almighty rip higher in the market. I'm not currently seeing that. I think if we get a rebound from the market levels, sure, I'll happily accept a bear market rally. But as for 5,200 targets, I think that's complete fantasy, and I'm in the camp that I think we are probably on the cusp of another leg lower. That is what the charts are essentially saying. If we look to Europe, again, we've got the FTSE pushing up against big support levels. We've got the German DAX. Again, I posted this chart to Twitter earlier in the week, just highlighting that it's potentially breaking down. We've got the Euro Stocks 50 index. Again, it's not bullish for Europe. We've got the Europe 600, again, very, very similar to the S&P, etc. All of these charts are right on the cusp, and they're on big support levels. And if these support levels break, then it's going to be a big problem in my world. Now, for many of you watching this, you might be wondering, well, how can I potentially hedge portfolios, etc., and look to make some kind of profit from a down market? Well, you could look to things like inverse ETFs. Again, Russell 2000, if we are going to break down from these levels again, I think it's quite logical to look to inverse ETFs. Now, for me, I don't like leveraged ETFs because you then open yourself up to those holy shit moments when the market opens and you've had a 2-3% move in the opposite direction to the trade that you're in, but because it's leveraged, it then becomes 9%, 10%, 11%. So for me, these charts make a lot of sense at the moment. The triple Qs again looks like it's a bit of a base, and if these charts break down, I think you can potentially look to these names. Now, many of you ask about individual stocks, individual charts. Now, I do have a few big tech names that I am going to cover for potential support levels, but I think front and center at the moment is something like Google. If we just add in the 61% there, I think the $90 level I think becomes the next potential area of interest for me. Again, for those of you that follow me regularly, you'll know that I was looking to potentially buy Google around 100, but there has been no bounce whatsoever in the market. We have started to take the next lower, so the next leg lower. So I am looking at $90 as a potential level. Again, very, very similar to Amazon. I called the bottom back in June in Amazon. Again, I called the top in Amazon a few weeks ago. Again, the $100 level I think will probably be key and a potential buy area for a stock like Amazon, but it will very much depend on the broader market. Now, we've had a big change of trend over the last couple of weeks in Microsoft, broken a basic trend line dating back to July 2016. So that's a change of character, and for me, Microsoft isn't terribly appealing at the moment. But of course, like all big tech names, they will rebound eventually. The big question is, when the market rebounds, I think that's probably the time to move in on a lot of these big tech names. Again, we're pulling back to a big level. I think for Nvidia, $116 looks to be a level to also pay attention to. Now, the other thing to say is, if you're still here, please hit the like button. It probably tells me that you're getting a lot of value from the charts and from my work. And like I said at the start, it all helps with YouTube algorithms, etc. There was somebody that made a comment last week and essentially just said that I should have a lot more subs than I do. And whilst I wholeheartedly agree, the problem I have is that I do not upload. I do not have the time to upload to things like YouTube regularly. So I just accept that I've got quite a small following, but every like does help, so please hit the like button and let me know in the comments if there are any stocks and what you think comes next for the market. Again, big downturn over the last 2 weeks with Apple. I'm sure that hasn't gone unnoticed. I'm looking at this 130 level as a potential level of support. But again, if the market is going to give us words like capitulation, basic support levels are meaningless. That's something to absolutely be aware of. If we start to see extreme selling pressure come into the market, it's very, very unlikely that basic support levels hold. And what the game then becomes, and it's something that I've talked about previously, going back to the COVID crash, where you just have to jump in and just buy that capitulation, and of course then you start to build your portfolio, and then take advantage of, hopefully it's not just a bear market rally, hopefully it becomes a market bottom. Now, if we look to things like emerging markets, again, most of you that follow me will know that I've been bearish on emerging markets for a long time. 100-day simple moving average, basic chart, and it is continuing to show a lot of weakness now with emerging markets. Emerging markets is, of course, 40% China, and of course China is breaking rank as well. We can look to the Hang Seng, again breaking support levels dating back to 2012. Again, I don't think that's particularly bullish for China. And of course we've got K-Web. Now, for me, K-Web, we had capitulation in this back in March, and it's been moving and ranging sideways since then, and potentially if China is going to take another leg lower, you would absolutely expect K-Web and a lot of the big hitters from China, the likes of Alibaba, JD.com, etc., a lot of those names will probably come under a bit more pressure. But for me, if the market does decide to break ranks and move a lot lower, please bear in mind that it is an opportunity of a lifetime for many. So I'm looking at this as a massive opportunity. For me, the easiest trade of my life this year has really just been to hold the US dollar and do not a lot. So for me, I'm quite prepared. I hope everybody watching is reasonably prepared for it as well if it does happen. Hopefully it doesn't. I would very much like to see the market rebound, and I think everybody would be a lot happier with that. But ultimately, for me, it makes a lot of sense to have some kind of game plan in place just in case we start to see all of these key levels in the market start to break down. So again, please, if you are still here, please do hit the like button. If you have perhaps just stumbled across my work for the very first time and you are wondering who I am, well, I'm Sam. I'm based in Scotland. My website is Honeystocks.com. We provide memberships to all of our retail and professional clients. Members, every single week we provide our premium weekend analysis. We provide access to our midweek halftime report. We provide access to our high conviction investment ideas, which I will show you what that looks like in just a second. We provide access to wonderful investing community. I provide access to my chart books, and of course also included is complete access to our complete technical analysis program, which I am told is very, very good. So just to show you what my work looks like, these are high conviction ideas. Of course, generally speaking, there's usually one or two per week. Given the market pressures this year, there's been a lot less high conviction ideas. All of my work has really been focused on the broader market, and obviously helping our clients and members navigate a very tough environment. But there have been ideas. ConocoPhillips was a massive winner very recently. Netflix was a good winner. The steel index was a good winner. Again, a short idea for the commodities index, a big winner. Zillow was a good winner. Box was a big winner. So we're very, very flexible, long or short. I think for those of you watching, I think there's a misconception that all of my work is purely based on long-only ideas. When the market presents opportunity to the downside, I will, of course, communicate that. But just to show you, the impact of my work, this is actually something that was shared with our community today. One of our members just really using options to play the extreme levels that I've been highlighting in August, June, etc. Of course, I understand not everybody has accounts this size, but absolutely, this is the impact that a lot of my work has. It's really just about identifying the key turning points in the market and helping our investors and members navigate that. But I'm very unique in what I do. Every single high conviction idea is logged on our website, so feel free to check that out. I don't know any other firm that does this other than one, and that other firm is considered to be the top dogs on Wall Street. But the purpose of this is just to highlight every single date, the price that the stock has been recommended at, and how those stocks have then gone on to perform. So I think if you have a mid-term approach, if you're maybe looking to get away from day trading, and maybe you just want to have access to all of my charts in real time, maybe you want to be part of a community, or maybe you're just sick of hunting around social media for all your ideas, again, I think we would probably be a good fit. And we are doing a very special autumn offer at the moment with 20% off all memberships. So feel free to check out our website. If you are still here, thank you very, very much for watching. Stay safe out there, and I hope to welcome you soon. Thank you.